The opening bell had barely stopped echoing across the floor of the New York Stock Exchange when the unthinkable began to unfold. Screens that only moments earlier glowed with cautious optimism suddenly flashed a sea of red. Traders froze. Phones rang unanswered. And within minutes, the Dow Jones Industrial Average was in free fall, plunging not hundreds, not 1,000, but thousands of points in a cascade of selling that felt less like a correction and more like a financial earthquake. By the time the dust settled, the Dow had collapsed by 3,800 points, marking the largest single-day crash since the infamous Black Monday of 1987. And perhaps most chilling of all, the very safeguards designed to protect the market, the circuit breakers meant to halt panic, proved powerless against the speed and scale of the collapse. From the first tick downward, there was a sense that something was different. Veteran traders who had weathered the dot-com bust, the 2008 financial crisis, and the pandemic crash exchanged uneasy glances. This wasn't ordinary volatility. This wasn't a routine pullback. The sell orders were relentless, sweeping across sectors with mechanical precision. Blue-chip stocks, the supposed anchors of stability, were sinking alongside speculative tech shares. Banks, manufacturers, retailers, energy giants, no one was spared. As the index plunged past the 1,000-point mark within the first hour, analysts scrambled to pinpoint a catalyst. Overnight, global markets had already shown signs of stress. Asian exchanges closed sharply lower after a surprise sovereign debt default from a major emerging economy sent shockwaves through currency markets. European stocks followed, battered by mounting concerns over liquidity shortages at several major financial institutions. But few anticipated that Wall Street would respond with such ferocity. The first circuit breaker was triggered when the S&P 500 fell 7%, halting trading for 15 minutes. Normally, this pause acts like a pressure valve, giving investors time to reassess and preventing algorithmic trading systems from amplifying panic. But when trading resumed, the floodgates opened even wider. High-frequency trading algorithms accelerated the selling, reacting to volatility signals and liquidity gaps. It was as if machines, not humans, were steering the market straight into the abyss. Behind the numbers flashing across screens were real human stories unfolding in real time. Retirement accounts shrank by the minute. Pension funds saw billions evaporate. Small investors who had spent years building portfolios watched helplessly as decades of savings were erased in hours. On social media, disbelief quickly turned to fear. "Is this 2008 all over again?" one user posted. Another wrote, "I just lost half my 401k before lunch." By midday, the Dow was down more than 2,500 points. The second circuit breaker loomed, and when it hit, triggered at a 13% drop, the trading floor fell into a stunned silence. For 15 more minutes, activity stopped. News anchors spoke in urgent tones. Economists debated whether this was the beginning of a systemic collapse or a violent but temporary correction. Government officials convened emergency meetings behind closed doors. The Federal Reserve released a brief statement saying it was closely monitoring market conditions and stood ready to provide liquidity if necessary. But the reassurance felt thin against the magnitude of the sell-off. When trading resumed again, something shifted, not toward stability, but toward capitulation. Large institutional investors began unloading positions to meet margin calls. Hedge funds facing massive losses were forced to liquidate assets indiscriminately. Exchange-traded funds saw record outflows as investors rushed for the exits. Liquidity thinned further, causing price swings to become even more dramatic. In some cases, stocks dropped 20% in a matter of minutes. The third and final circuit breaker, a 20% drop that would shut down trading for the rest of the day, suddenly seemed not just possible, but inevitable. As the Dow crossed the 3,000-point loss threshold, the atmosphere grew surreal. Traders described it as watching a slow-motion car crash that couldn't be stopped. Even safe haven assets like gold and U.S. Treasury bonds experienced unusual volatility, suggesting that investors were selling whatever they could to raise cash. By the closing bell, the Dow stood 3,800 points lower. The percentage loss rivaled the darkest days of modern financial history, and yet the closing bell offered little comfort. The damage was done, but the uncertainty remained. Was this a one-day panic or the opening chapter of a deeper financial crisis? To understand the magnitude of what happened, it's important to revisit October 19, 1987, Black Monday, when the Dow fell 22% in a single day. At the time, the crash exposed structural weaknesses in computerized trading systems and led to the creation of circuit breakers designed to prevent a similar meltdown. Today's market is infinitely more complex, interconnected by algorithms executing trades in microseconds across global exchanges. The irony is impossible to ignore. The very technology meant to enhance efficiency may have amplified fragility. In the weeks leading up to this crash, warning signs had been mounting. Inflation remained stubbornly high despite aggressive interest rate hikes from central banks worldwide. Corporate earnings reports began showing cracks, with several major companies issuing downward revisions to future guidance. Consumer debt levels reached record highs, and delinquency rates ticked upward. At the same time, geopolitical tensions simmered, disrupting supply chains and energy markets. The global economy, it seemed, was walking a tightrope, but markets often climb walls of worry. For months, investors brushed aside concerns, buoyed by strong employment numbers and resilient consumer spending. Stock valuations stretched to levels some analysts described as unsustainable. Margin debt, money borrowed to buy stocks, hovered near historic highs. When sentiment finally shifted, the unwind was swift and unforgiving. One particularly alarming aspect of the crash was the apparent failure of circuit breakers to restore confidence. While they temporarily paused trading, they did little to stem the tide of sell orders waiting in the queue. In fact, some critics argue that the pauses may have intensified anxiety, giving investors time to contemplate worst-case scenarios rather than calm down. As soon as trading resumed, pent-up selling pressure overwhelmed the market once more. The banking sector faced intense scrutiny as shares of major institutions fell sharply. Investors feared that losses in derivative markets could expose hidden vulnerabilities. Although regulators quickly emphasized that banks were well capitalized compared to 2008, memories of that crisis resurfaced with unsettling clarity. Credit default swap spreads widened, signaling rising concern about counterparty risk. Meanwhile, international markets reacted in kind. Futures in Asia and Europe pointed to further declines. Currency markets swung wildly as investors sought refuge in the US dollar and other perceived safe havens. Oil prices dropped amid fears of reduced global demand. Cryptocurrency markets, often touted as alternatives to traditional finance, experienced dramatic sell-offs of their own. On Main Street, the psychological impact was immediate. Financial advisors fielded frantic calls from clients. Business owners worried about access to credit. Home buyers questioned whether mortgage rates would spike even higher. The ripple effects extended beyond trading floors into living rooms and boardrooms alike. Government officials faced mounting pressure to act decisively. The Treasury Secretary scheduled an emergency press conference, emphasizing the resilience of the financial system and pledging coordination with global partners. The Federal Reserve hinted at potential liquidity injections or adjustments to monetary policy if conditions deteriorated further. But policymakers walked a delicate line. Intervening too aggressively could signal panic. Doing too little could allow fear to spiral. Economists debated the root cause. Some pointed to excessive leverage in hedge funds and private equity firms. Others highlighted the rapid tightening of monetary policy, arguing that higher interest rates had exposed structural weaknesses built during years of easy money. A few suggested that automated trading systems had created feedback loops beyond human control. For ordinary investors, the technical explanations mattered less than the bottom line. Retirement dreams delayed, college savings plans diminished, the emotional toll was palpable. Financial crises are not merely economic events. They are deeply personal experiences that challenge people's sense of security and stability. As evening fell on Wall Street, analysts pored over data, searching for clues about what might come next. Would bargain hunters step in to buy undervalued stocks? Or would further margin calls trigger another wave of forced selling? Futures markets suggested continued volatility. The next trading day loomed with uncertainty. History offers both caution and perspective. After Black Monday in 1987, markets eventually recovered, though the shock reshaped regulatory frameworks. Following the 2008 crisis, unprecedented central bank interventions stabilized the system, but ushered in years of unconventional monetary policy. Each crash leaves scars and lessons. One lesson often repeated is that markets are driven as much by psychology as by fundamentals. Fear can spread faster than facts. When investors believe others will sell, they sell first. In today's hyperconnected world, information and misinformation travels instantly. Rumors about failing institutions or policy missteps can ignite panic within minutes. Yet within turmoil lies opportunity. Some seasoned investors argue that sharp corrections can reset valuations and clear speculative excess. Companies with strong balance sheets and durable business models may emerge stronger. The question is whether this crash represents a temporary purge or a symptom of deeper systemic fragility. Late-night trading in futures markets offered glimpses of tentative stabilization, but volatility remained elevated. Financial news networks continued around-the-clock coverage, dissecting every statement from policymakers and every fluctuation in overseas markets. The mood oscillated between cautious hope and lingering dread. Behind the scenes, risk managers recalibrated models, clearinghouses assessed exposure, corporate executives held emergency meetings to evaluate contingency plans. The interconnected nature of modern finance means that stress in one corner can propagate rapidly across the globe. Perhaps the most sobering realization is how quickly confidence can evaporate. Just days earlier, market optimism prevailed. Analysts debated whether indices would reach new record highs before year's end. Then, in a matter of hours, trillions of dollars in market value vanished. As dawn approached in Asia, global investors braced for another turbulent session. Governments signaled readiness to coordinate responses. Central banks monitored liquidity flows with heightened vigilance. The world watched and waited. Financial crises test more than portfolios. They test trust in institutions, in regulations, in the stability of the economic system itself. The coming days will determine whether that trust can be restored swiftly or whether deeper reforms will be demanded. For now, the image of red-drenched screens and stunned traders remains etched into collective memory. A 3,800-point plunge, the largest single-day crash since 1987, circuit breakers triggered, yet unable to stem the tide. A stark reminder that even in an era of advanced technology and sophisticated safeguards, markets remain vulnerable to the timeless forces of fear and uncertainty. And as investors prepare for what comes next, one truth stands clear. The story is far from over. The opening chapter has been written in dramatic fashion, but the resolution, whether it brings recovery or prolonged turmoil, will unfold in the days and weeks ahead, shaping the financial landscape for years to come.